tumultuous week. A lot of people are wondering what's going on with gold and silver, especially the steep declines we saw on Thursday, Friday. Joining us on the program is Frank Barbera of the Gold Stock Technician. And Frank, let's get right to it. Let's start out with gold. And I think it's important to understand that we need to tell people that they raised margin requirements again. So let's begin with the gold and silver market.
Well, Jim, it's starting to look as though the central banks are just getting more and more desperate, isn't it? It doesn't seem like anything else can take the precious metals down except for CME margin requirement hikes. And other than that, you actually just take out 2 or 3 days of trading behavior that have surrounded these margin hikes. Basically there has been very little selling pressure at all in either gold or silver. The declines have been very heavily concentrated in very short periods of time. If you go back, in the case of silver, it was the late April period coming into early May, where in about 3 days, silver went from $50 all the way down to the high 30s. So we saw a pretty sharp drop there on a margin hike. And we've seen now 2 in gold, one in late August, and now the second one this week. So I think as an investor, that has to raise a fair amount of skepticism. It's not other factors. It's not changes in the global fundamentals that are causing these metals to decline. It's sort of an exogenous factor. I mean, for example, there was a little bit of a conference today in Europe was suggesting, various finance ministers are rallying to try and put an end to the European crisis by perhaps figuring a way to leverage the money that's in the EFSF, perhaps take 100 or 200 billion there and leverage it 10 to 1 so that it becomes $1 trillion plus as a backstop for European banks. And nobody believes that plan is going to work. There's just too many hurdles along the line. And so, if things were getting better, you would see the stock market up 500 or 600 points on a day like today when gold is down, if there really was a reversal from the flight to quality mindset. And that's just not happening. The reality is that the global economy seems to be sinking into recession. Global capital markets are moving into major bear markets, and the situation seems pretty grave. And in that situation, money will continue to move at precious metals as an ongoing flight to quality. Of course, you're going to have these corrections along the way, but for individual investors, the really key point here is not to let days like today get you off center. It's very easy to get emotional on a day when the market is pulling back sharply, in the case like gold and silver today, but that's really not the correct mindset. You have to look at this as a discount, a sale on something that you want to own, and basically that's very likely to be in an ongoing and continued bull market.
One of the things that I learned early on when we became friends at the beginning of the last decade, you told me that usually in a gold bull market, it is not unusual to expect 20 to 30% corrections. They happen almost religiously with the gold stocks every single year. And also sometimes with the bullion where, you may see gold touch its 40-week moving average. So talk to our listeners about that, because you and I have seen this rodeo ride so many times, but for new listeners and new investors, tell them how this really isn't unusual.
No, this is really quite routine. You do get these periodic violent shakeouts. What had actually been absent the market in the case of physical gold, we had seen a very extended run with basically very small percentage shakeouts, a couple of 6 or 7% shakeouts. This one's a little bit nastier. It's now on the order of about 11% off the high. But again, if you look at the structure of the gold market, the price structure, you're still making higher lows, higher highs. Today, for example, near the low, using the popular ETF GLD pulled back to its 100-day rising moving average. And, again, that's just a normal support. That 100 days is about 20 weeks, not quite half the year, but it's a very intermediate term moving average. That moving average is rising, and you have had essentially a regression to the mean here. You've pulled back to a big support area, which in the case of GLD is basically broadly the 157 to 160 zone. There's a lot of technical support there. And what we've also seen, and what I like to do, is I like to look at the options, what the options markets are saying about the various commodities and about the various stocks. And what you've seen in gold is from the highs in mid-August, around August 18th, we had huge, wildly optimistic sentiment, and all of the dollar-weighted call-to-put oscillators that I track were showing very, very heavy call buying. And now what has happened is that we are completely reversing that, and you're moving to a state right now of very deep fear. You know, humans, fear comes to us, and we move away from it. It's instinctive. And unfortunately, with markets, it's counterintuitive. You have to want to step up and buy the fear, and you want to be thinking about selling optimism. So it really goes against man's basic nature. But right now, for example, I brought a little data along with me today. I track, for example, on gold, the 2 front months worth of options data, and also the entire front 5 months worth of options data. On the 2 front months combined, we had $152 million worth of puts that were bought today against $67 million worth of calls. That $152 million worth of puts, that's an all-time record high. That's basically more than double the prior high. We had a reading of around $170 million, about a year and a half ago, but that was basically very high turnover, both calls and puts on that session. If you look at the back month of GLD, the premiums, the put premiums versus the calls today are almost 3-to-1. So we're seeing basically record put volume, record put premiums, and that tells me we have very high levels of fear. I did another little study after the close, and I went back over the last 12 months, and I calculated for each of the last 12 months how much in the way of dollar put volume we did each month, and then I took a 12-month moving average. And if you go back over the last 12 months, the GLD, for example, which is what I was working with, has had about $261 million of put volume per month. And if you look at the back 5, the first 2 months plus the last 3 months in GLD today, we did almost $250 million in total put volume in GLD. So in one day today, GLD did as much put volume as it has done on average over the last 12 months. So we did in one day's trading what we usually do in a month in terms of total put volume. That tells me there's a tremendous amount of fear, and instinctively, when you see that, you want to be thinking about buying opportunity in a bull market, not sell. And unfortunately, for a lot of investors who are new, that's a difficult step to get past. And, you know, the instinct is to walk away. That's never the right idea. You never want to hit the sell button on a day like today.
You know, it's also important to point out, Frank, that when your main interest is, in other words, if you understand what it is you're buying, why you own gold or why you own gold stocks, I actually like days like this. It's like, you know, Nordstrom's is having a 20% off sale.
That's right. That's exactly right. And they sent you a personal invitation to come in an hour or two early and pick up exactly what you want. You know,
buy, shop, and have lunch.
That's really true. No, it's really funny because I have friends who say, oh, you know, Frank's got exposure in the metals and the mining stocks. He must be having a terrible day. And you know, no, if you're well positioned and you really have a grip on the market, you're going to take days like today in stride. And I've actually had a pretty good day today.
Yeah, I mean, I'd love to go shopping on days like this, which is what I did personally.
A quick comment on silver, just briefly.
Okay.
You know, Jim, that one broke the lows that we saw in May and July. And I wanted to make just one comment on that very briefly. I believe silver will dig in this area between essentially using the SLV, which is a little easier for most people to watch, between 28 and 32. You should expect about 2 weeks worth of basing action. This is going to take a little time to repair, but overall I think between now and the end of the year we'll see a bottom in this area in silver. and then a steady improvement back up towards $40. It may be into the first quarter of next year before you see silver really moving again on the upside. So it actually could be almost April to April. It could be a net a 1-year break of sideways consolidation between 30 and 45 on silver. But I don't think that silver is going to go a lot lower. And I also wanted to make the point that put numbers on silver, other than the May 4th decline that we saw this year, today was the second highest dollar put volume in silver. So there's also a lot of fear there as well.